Welcome to If the Public Only Knew, the show that pulls back the curtain on what it really takes to build and lead a business. Host Gary Cinderbrandt sits down with some of today's most dynamic CEOs, founders, and leaders to dig into their origin stories, hard-earned lessons, and the missteps that nearly derailed it all. These are unfiltered, no-hype conversations designed to inspire, challenge, and fuel your own journey. Now here's your host, Gary Cinderbrandt.
Welcome back to If the Public Only Knew. I'm your host, Gary Cinderbrandt. And today, we're joined by someone that I probably crossed paths with at some point along the way from the financial world, Patrick Donohue of Hill Capital. Pat, thanks for joining us today.
Thank you, Gary. It's a pleasure to be here to share some insights on helping founders and executives build value in their work.
So Patrick, I appreciate that, and I'm all for that because I think that embodies the entrepreneurial spirit, but you didn't quite start out that way.
Well,
so let's go back in the day a little bit.
Sure.
Maybe bring up some names that aren't around anymore that you and I might remember, and tell me how this journey went from your entry into the world of finance to now trying to evaluate crazy ideas and see if they're workable.
Yes, indeed. Well, and I like many people, I started selling lemonade at 4, but I think as you're referring to, prior to recording, we were sharing some names from the past in the broker-dealer world and wirehouses and so forth. And so during college, I had the opportunity to have a handful of internships at places like Solomon Smith Barney, and was able to see how that world worked, and saw the value that good financial advisors provide to their clients, and really understood that. But at an early age, I knew I wanted to do something different. I think I always say that if I was born in the 40s or 50s, I probably would have been a traditional financial advisor and probably would have went on to create a mutual fund or a registered investment advisor and been an early pioneer there. But by the time I kind of went into the workforce, I felt like that market was fairly mature, so I had a different calling in life, and that's what's led me to create my own investment fund and to be investing in private companies. That's what we're doing today with Hill Capital. But I've had a lot of experience in the public markets, and so it's a fun space.
So you have your CFA, which for folks that don't know is your Chartered Financial Analyst, which is no easy thing to get, which qualifies you as an equity analyst, which is good because those are the only guys I would ever listen to. The tech guys, the market forecaster guys, the interest rate guys, I didn't know what they were talking about half the time. But a good fundamental analyst can come back and say and tell you, I visited this company and here's what's going on. So I always relied much more heavily on folks like you. How do we go from CFA to investment banking to private equity?
That's a great question. As I think about my progression of my career, I came out of college at Creighton University in Omaha, and I was wide-eyed and had rose-colored sunglasses on. You just kind of think that the world is everything's kind of perfect out there and ready to go, and you get in the business world and you see how disconnected things are. And that's where, when I started building, I was working at a regional broker-dealer at the time, and starting to work on deals and seeing this, but you start to see how disconnected, I would frame it as how disconnected Wall Street is from Main Street.
Mm-hmm.
But we're working on deals that you would think that would be easy to get done, and they're not easy to get done. And you just see how difficult some of these things really are. And so that's what was really the foundation, the inspiration to get into ultimately what I was doing. I think many people in your audience may be able to appreciate that, 25 plus years ago, when a company raised a couple $1 million, they went public. And, where I'm based out of Minneapolis, St. Paul, we had a wonderful culture of smaller broker dealers that would help take these small deals public. That's how Medtronic got going, St. Jude Medical. I mean, I could go down the entire list. But that just really doesn't happen these days. And so when I saw, the flip to decimalization and all the changes that were happening in the marketplace and in speaking of fundamental analysis, but I mean even 25 years ago, the cash and commissions available to pay Wall Street analysts was going down quite a bit. And now it's even on hyper acceleration. It's still mind blowing to me that there's traditional Wall Street analysts, especially with the AI tools today. But I just saw all those shifts. But at the core, I love that you pointed out, the Chartered Financial Analyst and doing fundamental analysis. But that's what I absolutely love doing. So it was a natural progression to be able to go into private equity and investing in private companies because day in and day out, I'm sitting down with founders and learning about their business and what their vision is long term and thinking about how to properly capitalize that business to be able to get to where they are going. And unfortunately, a lot of the fun in the public markets from that side of the table has largely been eviscerated.
No, I couldn't agree more.
So
Absolutely.
that's how I got to where I am.
That makes sense. And a background both with your CFA hat on and your investment banking hat on gives you a pretty unique combination of qualifications. I don't see that very much. Most people are either in one path or the other. You can always tell the investment bankers because they're usually miserable, especially the younger ones, as they're walking around trying to get deals done. So I applaud you for that.
Well, and I have it on my shelf in my background, but some of my favorite books is, Liar's Poker and
Yeah.
Monkey Business. And whenever I've had dozens of interns over the years, but I always, point that or give those books to young people. I'm like, this stuff's real. Like the Michael Lewis's story in Liar's Poker is real. And I just share that because you really to be good at investment banking, you have to be really good at sales and being able to schmooze people and win the deal. And that's fine, but what they're teaching in the business schools, of course, is to do the best discounted cash flow model. And it's not the best discounted cash flow model that wins the deal for the bank. And so the skill sets that are actually really needed, I think, are something very different than what young people are led to believe early
You
on
know,
in their
it
their.
never, one of the things I used to teach, and I have to give Merrill Lynch credit because they would
Yeah.
pretty much let me say anything I wanted. And when I started to explain to a group of advisors, many of them experiences that, Merrill is basically, we're on the sell side. We, go count the number of stocks we have a buy opinion on or a strong buy or even neutral and contrast that to the ones we have a sell on.
Yeah,
It's like, 0.01%.
exactly.
Um, the latter day, a part of that story was uh, you had Lehman Brothers carrying a AAA rating all the way through by Moody's and Standard & Poor's, all the way through the bankruptcy.
Yep.
I think they were relying on their cash balance at the end of each Friday, not recognizing they were doing repos and reverse repos with UBS in London, where you didn't have to mark your securities to market. You could just lend on par value. And even advisors, I tell that to, they're like, huh? What?
What did you just say?
What
Yeah,
does that
exactly.
mean?
Yeah,
I'm
what
like,
does
oh
that
my
mean?
God,
Well,
this industry's in trouble.
yeah, exactly. And and you've had a wonderful career in and around wealth management, and so you've seen all this. But to be a really good FA, at the end of the day, it's about gathering assets and it's really
Absolutely.
about sales. And that's what you're an absolute expert in.
It's
And so there's nothing wrong with that, but let's just, call a spade and recognize what it takes to be successful in these various careers. Uh,
the product you sell though
yeah,
is yourself.
yeah,
That's the only
exactly.
product we have.
Yeah.
And I think that's probably similar to what you're doing right
Oh,
now.
very much so.
Because as you know, there's probably a lot more capital chasing quality deals than there should be, as evidenced by some of the stuff you see financing on.
Yeah.
So talk to me about that a little bit. When you have someone come in, are they at the idea stage? Do they have a product? Do they have traction? What's their capital structure look like? How do you spot that next unicorn?
So typically, the companies that we are investing in, it's all vision-driven founders. So a founder with a really strong vision of where they want to go and what they want to build. They have traction, so they're selling a product or a service in the marketplace. We're not taking early stage bets. We're investing in established businesses that want to take it to the next level. So typically, What that means for revenue is typically they have a minimum few hundred thousand in revenue. They might have, several million dollars in revenue. The cap table, what they've already brought in for outside money can be across the board. We skew towards companies that have largely been bootstrapped because we're very interested in partnering and helping that founder build their business. So if they're on a traditional venture capital route, we have participated in some things there, but we would typically shy away because we are not a traditional venture capital fund. We're really investing in the founders to help them basically double or triple revenue over the course of our investment. And so that's what I love that it's all about people. I could talk all day long about our due diligence, underwriting, how we screen things, but at the end of the day, it's all about the people. Because any business that, in my opinion, is under 50, 100 million in revenue, man, especially these days with how fast technology is moving and so forth, the smartest people in the room can only be so good at forecasting what that business will look like in the next 5 years. But what is guaranteed is that there's going to be disruptions and things won't
Yeah,
quite go to plan. And that's why, as investors, we really care about who are going to be our partners. Because when things get challenging, is how are they going to show up and how are we going to see through
sure.
difficult times together? So that's
So
a
if you're dealing, I love that. You're dealing with an entrepreneur, they come in, they've got good vision, they've got some traction, they bootstrapped or maybe done a little bit of financing on the outside. How do you arrive at a valuation for your financing?
That's the key. Gosh, Gary, I just had an in-depth conversation with a couple of business owners and an investor about this very topic yesterday, people that lead a large angel investment group. So in angel investing, this has been a monumental problem, and it's the elephant in the room that most people don't want to talk about and are maybe even just too intellectually lazy to even have the conversation. But valuation is the big problem. And so that's why 99% of any angel investments are done under structures that kick the can on valuation. So that's why there's these safes and Series Seed and convertible notes, but essentially they're all kicking the can on the valuation conversation. And that's the right thing to do. With Hill Capital Corporation, we structure it where we have what we call our Hill equity based note. And that also, we have a valuation component, but we don't have to be caught up in that because we're really underwriting for an investment rate of return. So there's some key functions in how we're doing that, but we don't have to get too hung up on valuation. I share all of that because valuation at an early stage it's extremely subjective, and an investor is right to say that the company is worth very little and the founder is right to say it's worth a lot, and both are incentivized to lie to each other and convince and cajole that there's a high valuation or low valuation, and both are right because valuation at the end of the day is really simple. It's literally the net present value of whatever that asset is going to create over time. Well, who has the view of what that is going to be created over time? The best person is the founder to what that can create over time. But investors need to be able to get in at a price where they can get a reward, a return that justifies the high level risk that they're taking in these early stage investments. And so valuation is a really, really important topic. It's really difficult for the early stages, but a lot of these structures are being done to kind of kick the can on the valuation. But there's a lot of nuance to all this stuff that if people aren't accustomed to these things, aren't used to it, both sides of the table can get harmed. And that's why at Hill Capital, we have spent a lot of time and resources over the last 10 years really putting together a structure that works well for both sides of the table, because that's the absolute important thing to do with these companies, is to help them get not only properly capitalized, but make sure that it's capital that can work irregardless of whether it goes really well or really bad. I mean, really, really bad, if it's a zero, that is what it is. But if there's a situation where, they plateau and it only does so well, it's like, okay, then what? Because a lot of VCs, a traditional VC will just shut a business down
Yeah.
if it doesn't become $1 billion thing. And that's a sad day for a founder.
No, I like the direction you're going because, in the case of some of these kick the can down the road, like a safe note, if you don't get to a subsequent round, there's no valuation. They don't own equity. It's just not there. And you end up with zero. And it sounds like what you're doing has some form of a hybridized component between equity and debt. I assume there's some sort of valuation cap that the early investor gets, that you're not going to take them take it out too far in that next round. How do you deal with, let's say, a company that meets it or exceeds all your expectations?
Mhm.
They want to go out and scale for subsequent financing. You're involved in your fund. Do you
Yep.
stay around as an advisor with that company and help them in subsequent rounds when they're might be going out and raising a larger institutional round or even negotiating with a VC?
The quick answer is it's completely up to the founder. The vast
Mm.
majority of the time we stick around because the founders want us around. And we've helped many of our portfolio companies raise, I mean, in aggregate, it's now in the tens of millions of dollars. And so as of this recording, we've done 18 investments for $14 million. But these companies have gone, a few of them have gone on to raise a heck of a lot more money. And we've been very helpful in that whole process. We're happy to do so. But what's important, Gary, is we always, when we underwrite these things or we tell founders on the front end, we want them to have optionality. And so they can take us out in whole, including all of our equity rights in whole at any point in time. And that's a really important feature that we have and like next to nobody else does. And we want to provide that to the founders so they have complete optionality on how to build their business. If they want to build it and be able to take on an SBA loan or traditional debt financing and continue to have it closely held or as a founder own it 100%, we want them to have that optionality. If they want to go raise tens or hundreds of millions of dollars in venture capital, we want them and empower them to be able to do that as well. So our structure actually allows founders to pick whatever path works best for them. And that's a really important feature set of our investment structure.
Yeah, it's unusual. It's
Very
very
so, very much
very
so.
pro relationship,
Yep.
and it's very empathetic to do it that way because you understand the heart of a founder.
Well,
Um,
I am a founder. I found a couple
there you
businesses,
go.
including Hill Capital. So yes, I
Right.
absolutely do get it. Yep.
I think that's fabulous. So this is all your company itself has been bootstrapped, or do you have outside investors in Hill Capital, or how's that set up?
Yeah, so it started bootstrap myself and a couple people put in the money, made it happen for a couple years. We do have a handful of investors that are our partners in Hill Capital Corporation. What's really important about us, Gary, and all the capital that we have in our investing, it's all individual capital. We run no institutional money. Um, and so that's what's really important is that's why we are truly partnering with these founders. It's our money at play. And so that's why those relationships are very important to us. In other companies I've founded, I'm in the camp that I like to bring in other people. So I've, co-founded a couple of other things. I've always had like 50-50 partners and we've brought in a handful of other people. Not even so much that we needed the money, but I wanted them to have some skin in the game to be able to have them as board members and build those relationships. And so I'm cut for that cloth. I'd rather bring some people in and have them be part of a team, but I also deeply respect and understand when people own 100% and want to keep 100%, and I want to empower that as well.
Before we started recording, you and I were talking about an avocation we both share, which is we're
Oh
both
boy, we're gonna
ski.
go there, Gary. Really?
Well, just briefly, we won't
Okay.
talk about our favorite organization, but
Yeah.
one of the things that I did learn as I was learning I mean, it was always a good skier, but becoming a good ski instructor, as you well know, is
Yes.
very different than being a good skier. And what I was mindful of was a good ski instructor will meet their client, meet their guest where they are. It's not about what we want them to do. It's about where they are. They've got a whole different set of experiences. And it's not do this, do that, do the other thing, as you would see in traditional investment banking or even VC. So I applaud you for what you're doing because you're meeting founders. And I love the fact that you said everybody is a little bit different. And we see our role as enabling them and moving them further up the chain. I think that, not only is that economically smart, I think it's socially laudable that you're out there doing that. Good for you. That's great. Where do people find you if they want to learn more about you or they've got some crazy idea they want to run by you? How do they
It's
find you?
yeah, really easy. Hill Capital Corp, corp.com, and also breakoutvaluation.com.
Okay.
People can email me, Patrick at breakoutvaluation.com. I respond to all my emails. And if I'm a big user of LinkedIn and not much else for social media, so people can utilize LinkedIn. And just mention that they connected via this podcast, because I do need to be able to connect the dots on how we connected, because I
That's
get a
awesome.
lot of outreach. But I'm always happy to connect with anybody, but especially founders. If there's anything I can do for founders, they have our ear, and we will help wherever we can.
That's
So
wonderful.
yeah.
Thank you so much for joining me today.
Likewise, Gary. Thanks for all the work you do.
Pleasure. Our guest today has been Patrick Donohue, CEO and founder of Hill Capital, and someone that's good to have in your Rolodex, I would think. Somebody you can call, somebody you can learn from, and maybe one day we'll take some turns on the hill together. Thanks again, Patrick.
I look forward to it.
Thanks for tuning in to If the Public Only Knew. Don't forget to follow the show and share it with anyone who's ready for the real raw stories behind the business successes. Join Gary next time for another powerful conversation that will leave you inspired and ready to take action.